let's say that inflation isn't 5.1% or 5.4%, wherever it comes in on a monthly basis now. And we all agree it's something that is higher, but there's disagreement on how much higher. Is it 6% or is it 14%? What happens to all the people who are using CPI as the benchmark? Do they just succumb to the inflation over time and continue to lose money until they wake up, or something else?
I think a lot of people have a hybrid situation. Like, for example, let's say I run a real estate trust or I run a real estate company and I have $100 million a year worth of rental income. Mm-hmm. It's capped at CPI. The leases are signed 10 years, 20 years, 30 years duration, 5 years duration. And then you've got all the trade relationships. Like I can't go to the people that rent my building and tell them that the inflation rate's 14%, right? I mean, would you pay a 14% increase in your rent here? No. So there's a certain inertia in parts of the economy where they're going to move up at CPI, or they're going to be flat, or maybe they can do double CPI. But at the same time, maybe you're the person running that real estate company. You're thinking, well, I'm going to take my cash flows and I'm going to invest them in. Would you invest them in a stock that you thought would go up at CPI? Or would you invest them in the S&P index if you thought you would get CPI? Not really. Yeah. So what you have is you have people that are sweeping their cash flows from an operating business that's low growth, and they're putting in the S&P index. If,
they're looking for the growth to come from the investment.
Okay, the S&P is up 34%. How many companies in the world generated 34% more cash flow or raised their prices by 34% or grew their revenues 34% in the last 12 months? Mm-hmm. Not many, right? Yeah. 98%, 99%, they're in a fiat operating system where they're going to raise their prices or generate cash flows at a rate slower than the rate of monetary inflation. Mm-hmm. But those same people will turn around and they'll buy Bitcoin, or they'll buy property, or that you may buy property that is going up faster, right? There's not a single commercial rent. There's not a single commercial lease, I think, in the world where they raised the price of the rent 27% in the last 12 months, right? Mm-hmm. At least I can't imagine if you had a lease, no one's got it capped at the Case-Shiller index. So on one hand, residential property or other types of property could actually be accreting at a much higher rate while your rents don't accrete at a higher rate. So you're taking duration risk. So I guess the more important point is there's a lot of capital. When we think about capital structure, it's like $500 trillion to $900 trillion of capital floating around there. It's locked up in structures. Some of it is in currencies and it can move rapidly. Some of it is invested in companies that can't, right, move rapidly. Some of it is tied up in equity. Some of it is tied up in debt. Some of it's tied up in a trust. I have a trust. My trust gave $10 million to a financial advisor or to a company whose strategy is investing in mid-duration corporate debt. And every year I review their performance versus their index. And over the course of a decade, I might start to shift small amounts out. But I think that the capital is structured in such a way, there's enough inertia in the system that it could take 30 years for the capital to get reallocated. Like we're waging a war on the 60-40 portfolio, right?
Is it dead?
How long will it take before people allocate that as 65-35 or 70-30, right? It takes a long time. There are people still invested in gold. You and I joke about that. Gold's been failing for 12 years or something like that, right? Gold's the same price as it was when Bitcoin was invented. And yet an aggressive move would be a macro investor allocating from 50% gold to 45% gold and 5% Bitcoin. And that's a year's work.
Yeah.